inflation and just kind of take a step back. For those of you who have been following our thinking for a while now, really the story that we laid out almost more than 18 months ago was this basic idea that the U.S. was experiencing a late cycle. That late cycle was predominantly income driven rather than credit driven. That it would lead to inflation that remained elevated relative to the Fed's target for an extended period of time, and that the Fed would need to tighten meaningfully in response, and that it would take a lot of tightening, much more so than people expected in the summer of 2022. It would take a lot more tightening, and for that tightening to exist longer, be in place longer than people expected, in order to slow the economy and start to alleviate those inflationary pressures. And I show these three charts because they basically show how that story, which was a very non-consensus view of how this cycle would play out, certainly in the summer of 2022, has largely been the story for the last 18 months or almost 2 years, which is, the unemployment rate has been, at 4 or below for an extended period of time. Asset prices have performed poorly relative to cash for almost 2 years, using the chart in the middle, which is RPAR, which is a portfolio of risky assets balanced to different economic conditions. So not overweight growth or inflation or things like that. And then finally, that interest rates, which were raised relatively aggressively through the course of 2022 and really sort of entered the range that we've been in by the fall of 2022, have been elevated for an extended period of time in this range between basically 4 and 5% on the short end and on the long end. You add that all up together, that the cycle is basically playing out as we had expected over the course of the last 2 years. And the thing I would emphasize about that is that that cycle playing out is not a cycle that's playing out without a slowdown. It's just a much slower transition than what most people had expected. But a transition is occurring in the economy. We've had elevated interest rates for an extended period of time. As a result, that is starting to weigh on various sectors of the economy, and slowly, very slowly, glacially, the economy is moderating, and we're transitioning to a slower economy that is necessary in order to bring inflation down towards the Fed's mandate. But that process it's not an instantaneous one, and it's not an acute one. This isn't a crisis dynamic. This is a traditional late cycle slowdown of the economy, which is flowing into moderating inflationary pressures. And that's basically what we're starting to seeing there with the unemployment rate, a modest loosening of the labor market. Certainly the move from the mid threes to right around 4%. That is not a significant loosening of the labor market, and 4% on any long-term basis is extremely low. But it does reflect the fact that there is some softening occurring in the economy. And that's an important point to be making, which is that that softening of the economy is occurring at a time when the expectations of how growth will transpire in the future are finally catching up to the near 2 years of strong growth. And so that's what we show here on this chart, which I think is just a really important dynamic. Whenever you're trading financial markets, you're always trading financial markets relative to the expectations that are priced in. And for an extremely long period of time in that cycle, over the course of the last 2 or 2.5 years, we had basically seen a variety of times when expectations were that growth was likely to slow materially. And the kickoff of this year was really no exception to that story. We had been in one of those transition points where growth expectations if you look over here on the right-hand side, entering the year in December of last year, we're running at, under 1% real GDP growth year over year, which was quite soft, certainly in the context of the fact that stocks had been booming, bond yields had come down, and the economy was receiving one of the biggest stimulations that it had seen in 40 years. But what's really happened over the course of the last 4 or 5 months has been a transition. That transition has been where people are now increasingly expecting the strong growth that we've seen over the course of the last couple of years to persist essentially forever, just at the time that we're starting to see signs that that growth is starting to moderate. And so that's what you see here in this chart. That's what you see here. It's really the growth expectations, really by April and May had reached a fevered pitch. It was a big reason why stocks outperformed bonds in the first quarter, but we've gotten to a point where those growth expectations are very elevated. So, private investment above 3%, household demand 2.5 to 3%, and overall real GDP growth expected for the year at 2.5% or 2.4%. That's important because we had a real GDP number in the first quarter that was 1.3%. And so what that means is what's essentially being priced in as expectations for the rest of the year is a 3% real GDP growth rate through the end of the year from economists' expectations. But it's not just economists. This isn't just theoretical economists going out there and penciling out 3% real GDP growth for the rest of the year. It's also in that sort of expectation is in stock prices and the current elevated stock prices that you see. Earnings expectations, which you can see on a year-over-year basis on the left-hand side and on a quarterly basis on the right-hand side, are now pricing in, double-digit expected returns in earnings. And in particular, the Q4 2024 bottoms-up analyst expectations for earnings year-over-year growth is 17%. That's notable in the context of the fact that earnings growth, if you look over the previous 6 quarters, hasn't been particularly significant. And it's also important in the context of saying, look, we've had a pretty good growth picture in the U.S. context, pretty good nominal growth over the course of the last couple of years, but that nominal growth is 5 or 6%. That nominal growth isn't anywhere close to the type of nominal growth at the top line that would be necessary to generate the sort of expected earnings growth that's currently priced in the market. And that is further extended, expectations of that are further extended with earnings growth expected to grow around 14% in 2025 over 2024. Now, of course, these analyst expectations, they're always a little elevated relative to the reality, and they always get cycled down. But I think what they reflect, this and the economist's expectation, is expectations for the U.S. economy. What we've had is, after years of people finally sort of coming to acceptance that the U.S. economy was stronger than they expected, they're now penciling that out to basically continue for forever, just at the time when the softening is occurring. In addition to that, we continue to have inflation in the economy that remains elevated in comparison to the Fed's mandate. So whether you look at economists' expectations for 2024 at 2.8%, the Fed's dot plot, which was also at 2.8%, or just simply penciling out based upon the data that we've seen, the rest of the year at 0.2%, what you'd see is core PCE numbers that are still above what the Fed's mandate. And so while we've certainly made progress from the point where inflation was running, at 5% core PCE at between 5 and 6% a couple of years ago, inflation remains a little too elevated. And those folks, who are looking at the most recent CPI report from yesterday and extrapolating those relatively, extrapolating that into the future, I'd suggest some caution, given the fact that both the internals of that CPI report suggest that it was an unusually weak report, as well as the fact that triangulation across other measures of inflation don't show nearly the abrupt slowdown that would be implied by that 1 month's report. And so I think penciling out this basic picture of, inflation continues to be elevated, not as extremely elevated, but moderately elevated relative to the Fed's target ahead. So we have very high expectations of growth, elevated inflation, expectations around central bank policy, which have started to moderate to the point where really what we're seeing in terms, even with yesterday's expectations, yesterday's inflation print, the Fed has largely reset expectations that they're going to cut between 1 and 2 times over the course of the year, through the remainder of the year. Now, they might cut 0, they might cut 2. It's certainly a lot different than what it was when we were coming into the year, when we held our kickoff of the year webinar, Outlook webinar. And at that time, we strongly questioned whether it was reasonable to expect the Fed to cut 7 times. Now we're down at 1 to 2 times, which is in the ballpark of probably what's reasonable. On the margin, my expectation would be, given the data that we're seeing, that they'd be a little slower than what's priced in, but the easy money has been made on that trade. Whether any way you take it, what that shows is an environment where central bank policy is not going to bail out the financial markets anytime soon. We have a continuation, most likely, of higher for longer policy that is at least going to last through the end of the year. That's all happening in an environment where expectations of risk in the economy are basically at secular lows. Whether you look at the VIX or you look at credit spreads, both are reasonable ways to try and get a sense as to how risk is being priced. And so, in both cases, you're basically looking at tights, and tights, multi-decade tights, when it comes to the risk being priced into the economy. And so I think that's an important story when you look at the picture, which is very high growth expectations, no volatility priced in, inflation that's above expectations, central banks that are tightening, that continue to run relatively tight monetary policy. And the last thing I'd emphasize is no risk premium priced into financial assets, to holding financial assets. And so whether you look at the bond market and you look at the term premium on bonds, we basically have a term premium on bonds that's about 0. There's lots of different ways to measure this and think about this, but the basic picture is the term premium in bonds that you're getting today is equivalent to roughly the average over the course of the last 15 years. And the U.S. economy today is very different than what it's been on average over the last 15 years. And so you're getting 0 term premium in bonds. And on the equity side, from a longer term perspective, if you just look at the equity risk premium, which is, one way to look at it is the earnings yield minus the real bond yield. That's what you see over here on the right-hand side. What you see is essentially the premium for holding equity at this point relative to holding bonds is about as low as it's been since the early 2000s. And so if you just add that up, there is no premium for holding, or low premium for holding equities relative to bonds, long-term bonds. There's very low premium in holding long-term bonds relative to cash. There's very little risk priced into the system. And so and there's very high growth expectations priced in. So if you take that picture as a whole, what you'd look at and you'd say is an incredibly benign scenario is already reflected in asset prices today, despite the fact that we're seeing inflation above expectations and a continued tight monetary policy environment. And I think, drawing on Andy Constan's classic chart in terms of the various islands, I think it's very important to sort of put in your mind what set of events needs to occur in order to get further asset price appreciation in this environment. We're already heading east of soft landing island being priced in, almost to a near magical environment where bond yields are falling at the same time stock prices are rising, and the same time growth expectations remain at elevated levels, because if they fell, that would hurt stocks. And so what is the constellation of what has to occur in order to get something like a 10% rise in stocks and bonds over the course of the remainder of the year? And what that requires is essentially a significant decline, another 50 basis point decline in the bond yield at a time when growth expectations in the US economy would have to continue to remain at extremely elevated levels, and earnings expectations would have to remain at extremely elevated levels. That's going to be a pretty hard lift, is the reality, because the type of environment that would typically create a meaningful decline in bond yields at this point, would be the sort of environment where you'd have to get an economic slowdown. And you sort of see that in the market action even today, where some modestly weaker than expected growth news and modestly weaker than expected inflation news is netting out to an environment where bonds are rallying, but stocks aren't. And so you're not, the question is, how do you add it all up to get that stock rally and a bond rally at the same time? It's going to be pretty difficult in an environment of tight monetary policy for an extended period and inflation, which remains elevated. And all this really comes back to, from a growth perspective, it really comes back to the fact that we are in an income-driven cycle. Those of you who follow our work regularly are probably sick of me talking about the income-driven cycle over and over again. But I think it's an important framework, mental framework, for thinking about, what is the core growth engine of this economy? And what it is at some level very simple, which is that the continued nominal spending growth of households is flowing into nominal earnings growth, whether it's wage growth for households or earnings growth for companies, which is then allowing companies to continue to raise their wages, which is supporting, again, the continuation of nominal spending growth. That cycle is one which it is not a spiral. It's self-reinforcing in the sense of one person's income and spending then becomes another person's income and then spending. So it's self-reinforcing, and it is a durable dynamic because the fact that you're spending out of income, if you look over the last 12 months, the savings rate of households is basically flat. And so what you're seeing, as you see on this chart, is that nominal spending is aligning with nominal incomes. And so those things are durable in the sense of there isn't an unacceptable buildup of excesses that occur as a result of an income-driven expansion, the way we saw, for instance, back in the 06 to 08 period when there was, a debt boom, or the way we saw amongst corporations in the 98 to 2000 boom, where they were borrowing a lot to invest in new technology. And so this is a very sustainable dynamic, but it's one that is best thought about as sort of consistently being eroded by that tight monetary policy that's remaining in place for an extended period of time. And that's basically what we see. If you think about income, it comes down to basically two sources. Income growth comes down to two sources: employment growth and wage growth. And when you look at that picture, we're basically seeing a sort of persistent grind in terms of both of those elements slowing down over time. Whereas, in 2021, we had very high employment growth coming out of COVID. It moderated, for the 18 months sort of up until January 2023. And really, if you look at the employment numbers over the course of the last year or so, 18 months, they've certainly moderated relative to the strength that we saw before. That's sort of normal in a late cycle environment as we're starting to bump up against our limits. But when you take a look at the combination of both payrolls and the household survey, both of which are like imperfect on their own. Payrolls probably has a little too much birth death support. Household survey has some issues in terms of capturing net migration and the support that exists in terms of measuring the job market there. But when you put the two things together, it's pretty clear that employment growth has moderated to some extent. And remember, this is all in the context of what's being penciled out in terms of expectations is a continuation of the type of strong growth that we saw in 22 and 23 being penciled out to exist for the rest of 24. And then on the earnings side, the income growth side, you've also seen some moderation there. Here, choosing to look at average hourly earnings, although you could look at most measures. What you see is that sort of annualized earnings growth. It was a little stronger a couple years ago. It's moderated to some extent. And you put those two things together, and what you're seeing is sort of a glacial moderation of overall incomes, which is leading to a glacial moderation of spending. Again, in the context of expectations of that earnings growth and economic growth to be at highs for the cycle. So the real economy is moderating when expectations are basically at highs. But even with that, I think one of the challenges from the Fed's perspective is even with the moderation in income growth and in particular wage growth, we haven't quite gotten to the point where inflation has durably come down to the Fed's mandate. And not just measured inflation, which has all sorts of limitations. What I describe as structural inflation hasn't come down sufficiently to the Fed's mandate. If you look over on the left-hand side, ECI, another measure of compensation, that is sort of the sort of gold standard measure of compensation, which has certainly moderated over the course of the last couple of years, but remains a few points more elevated than what we saw in the pre-COVID period. And you compare that to what's going on with productivity growth, because ultimately, just very simply, if you think about what creates structural inflation in an economy, it's the difference between nominal wage growth and productivity growth. And the reason why that is if you just think about nominal wage growth as how much are we paying someone to do an hour's worth of production, and you think about productivity growth, which is how fast is their ability to produce growing. The difference between those two things essentially has to be resolved by changes in price, because it's just simply the amount of dollars of income people have relative to the amount of incremental stuff that's being produced. And of course, there's a lot of measurement, imperfection in that, but that concept is definitely true. And what we see in terms of the picture of productivity, I think, is one that should concern most people who think that the inflation problem is fully resolved, which is, even though we've had a moderation in nominal income growth, as highlighted in the previous slide, productivity growth remains relatively modest. For all the promise of technological innovation radically changing the productive capacity of the economy, essentially we haven't seen any productivity growth since the amount of spike that we saw in the layoff dynamic immediately surrounding COVID. And the most recent quarterly numbers certainly didn't suggest that we were on a renewed path. And so I think this is really the nubby question, which is, are we going to see productivity? We're definitely seeing wage growth that's elevated relative to pre-COVID. That's kind of a given. The question is what's going on with productivity growth, because that's going to help define what the structural inflationary pressure is. And really, are we on that blue line of accelerating productivity growth, or are we going to stay within the bands of the gold lines for an extended period? And what I'd highlight is, if you think about, predicting productivity growth is a very challenging thing to do. But if you think about what other points of triangulation you have, for instance, other developed economies, places like Europe and the UK have seen near zero productivity growth for a number of years as well. This, and those economies are certainly, while they might have less structural vibrancy than the U.S. economy, many of the access to innovative technologies and things like that are all sort of the same in those environments as well. I mean, there's a reason why European growth, as a simple example, has been running around zero, give or take, for the last couple of years, yet the unemployment rate is at secular lows, which highlights the fact that labor productivity remains relatively low in a long-term context. And the same, is a little softer in terms of the unemployment rate, but in the UK, but the same basic picture exists there as well. And so you basically see this picture. This is what's creating the structural employment. So we have moderating growth, nominal growth, and at the same time, we have inflation pressures that still look as though they're going to be present for an extended period of time. And of course, measured inflation numbers here continue to be elevated relative to where we were pre-COVID. PCE equivalent, the Fed said 2.8. Economists are expecting 2.8. Even running at, if you look across many of these numbers, these are PCE numbers through April, so they don't include what will likely be a very soft print in May. But the general trend here is, continued to see inflation that is moderately above what the Fed's mandate is. So they're going to have to maintain, given that context, they've been clear if year-over-year inflation in the US is 2.8%, if you just take the dots at their word, the Fed will maintain tight monetary policy through the end of the year. In addition to that, the fact that we're likely to see money remain tight, we're also likely to see a continued flow of significant bond selling by the U.S. Treasury as a function of the continued elevated deficits. The Treasury is basically committed to say that they are likely to issue the same share of bonds versus bills on the deficit for an extended period of time. And so what you see here is a basic story where the amount of gross issuance, total bonds and notes gross issuance, is likely to remain at basically secular highs in an environment that's very different from that previous high when there was substantial money printing. We continue to have the Fed to a modest extent roll down the balance sheet or slow the balance sheet, and we continue to see this pressure of constant bond sales coming into the market. Any one day, of course, those bond market sales can be absorbed, but over a period of time, in one form or another, asset prices need to fall. And when I say asset prices, I mean aggregate asset prices, right? So something like an RPAR, a balanced portfolio of asset prices needs to fall in one form or another, given the constant supply and quantitative tightening that's coming into the market. And that's only exacerbated by the fact that the Federal Reserve continues to run monetary policy that's relatively tight for an extended period of time. So given these pressures, the real question is basically, how do you get the next 10% leg up in either stocks or bonds? And I think the story that has to be told is pretty challenging. It's a pretty challenging, needle to thread in order to get an environment where that next leg up in asset prices actually occurs. And then the pressure on the U.S. bond market, I think, is particularly important when you think sort of globally. Like globally, the world is benchmarking off of the U.S. bond market. Basically all assets in one form or another are being benchmarked from it. You see there in the upper left-hand corner, the shifts in the bond market, the up move in April and then the down move and chop over the course of the last 6 weeks. That basically aligns with what you're seeing in terms of the bond market action in the UK. U.S. conditions are different from those in the UK, yet the UK bond yield is basically trading on U.S. conditions with slightly less beta. You see that in the stock market. In April, the bond yield rise creating a drag on the stock market, and then the resolution creating a lift. You see that in global commodity prices. They're shown with the CRB. And so you add that all up, and you actually see a situation where, the U.S. bond yield, what is transpiring with the U.S. bond yield, it becomes the central lever to what's going on with the world. And so when you're thinking about what is going to create a further up leg in asset prices, what you have to say is, even in an environment of tighter than expected monetary policy and higher for longer, even in an environment where there's tons of bond supply coming into the market from the fiscal picture, you have to create, in order to believe that asset prices are likely to rise, particularly stocks in the US are likely to rise, you're going to have a story of bond yields falling meaningfully without a significant lowering of growth expectations. And that's going to be a pretty challenging lift. I think the other thing that's important to think about when you're thinking about the bond market is just how important those foreign central bank flows have been, or those, not central bank, but foreign private sector flows have been. U.S. yields for almost 25 years typically ran below those of foreign counterparts. And the reason why that was because the US was the reserve currency. And so we could run lower interest rates relative to the rest of the world and experience a constant bid on US bonds. Um, and the shifts of the US economy being stronger than the rest of the world have lifted bond yields over the course of, have lifted bond yields relative to the rest of the world, for an extended period of time. And what we're seeing is a significant flow into US bonds that is reliant on foreign private investors flowing through and buying US bonds. The challenge with that is that the way in which that will persist is if those other economies experience substantive easing pressures in order to basically bring down their rates and make US rates more attractive and bring capital into the US. And I think there's reasonable questions about whether that's likely to persist. Now, of course, the ECB, did cut for the first time this cycle recently. But I think anyone who was listening to what was going on and seeing the path there, it was about the most hawkish cut that you could have expected coming out of the ECB. And the reason why that is I think there's two main issues that continue to exist from the ECB's perspective. The first is that economic conditions, while they have been structurally soft, are not that bad. Unemployment rate is at secular lows. And if anything, what we see is some timely measures shown here by the composite PMI are suggesting that there might be actually a pickup in economic activity over the course of the last 6 to 9 months. And then second, of course, is the problem that inflation, underlying structural inflationary pressures in Europe remain relatively elevated. Here, showing negotiated wages on the lower left-hand side, printing a number that it continues to be elevated relative to history and certainly quite a bit higher than where we were pre-COVID. I think it's a really important point because essentially what that's saying is where is the urgency for the ECB to do a whole heck of a lot more? I think they had signaled that they intended to cut and they delivered that cut, but that doesn't necessarily mean they're entering a substantial cutting cycle immediately. And the flavor in the UK is very similar, I'd say marginally less, it's essentially the same, which is you have economic conditions that are weak but accelerating, and you have inflationary pressures, particularly around wage growth, that continue to be relatively elevated. Unemployment in the most recent report earlier this week did soften just a tad, but we're still seeing very high nominal wage growth in the UK, and it's going to be pretty tough for the Bank of England to deliver a massive flow of cuts in an economy that's showing some signs of perking up, and in an economy that continues to have very elevated wage growth relative to pre-COVID levels. So the bailout, for global investors, the UK and Europe, they serve as they serve as a market that you can trade. I think the most important impact that these policy shifts have on what's going on in the US is that we're unlikely to see a significant shift towards easing in those economies. And without that significant shift towards easing, the flow of capital into the US bond market is unlikely to be nearly as strong as it's been. And so that is just another pressure which is limiting the amount of flow of capital into the US bond market and to US financial assets, which adds further pressure on US financial assets. Japan, it continues to be soft. And despite the fact that, they've been running very easy monetary policy for an extended period of time, inflation has come down. It's below their target now. Growth has been negative 2 of the last 3 quarters. And that 0 isn't doing a lot for the Japanese economy. And it's pretty remarkable how the pressure on the yen has continued to persist, even in the context of US yields coming down something like 50 basis points over the course of the last couple of weeks, and Japanese yields surging 20 or 30 basis points as well. And despite all of that, and the huge interventions that the Bank of Japan has delivered over the course of the last couple of months, the Japanese yen is basically where we were, 6 or 8 weeks ago, in terms of trading in the high 150s. I think what that highlights is, from an underlying perspective, this is not an economy that's transitioning to meaningful tightening anytime soon. And I would be cautious about interpreting rhetoric in that direction. We'll get a little bit of a read in terms of what the BOJ is thinking late this evening. But we're unlikely to see a big shift to tightening. And without that shift to tightening, the underlying structural pressures on the yen continue to be relatively substantial to the downside. And so while the BOJ or the MOF might continue to intervene to push a disorderly, to push against a disorderly decline in the currency, it certainly doesn't look like the type of fundamental conditions have changed meaningfully enough to create an environment where the yen is shifting towards an extended appreciation period. China, I'll leave off with China, which I think, again, from a trading markets perspective, the dynamics in China are interesting as their own market. But I think probably more interesting from a global markets perspective is how the pressure on the Chinese economy and currency is flowing into the rest of the world, and particularly leading to domestic demand for gold. What we see here, we've gone for 3 years with wave after wave of this is going to be the China rebound. This is going to be a policy-driven China rebound. And there is no indication that the Chinese authorities have done anything close to enough to create a meaningful and lasting substantive rebound. And so while sentiment whips around positive and negative, the reality hasn't really changed much, which is China is growing in a way that is weak relative to its underlying productivity and its underlying potential growth, and policymakers aren't doing enough to deal with that. And why they're doing that, that's a political question rather than a macroeconomic question. From a macroeconomic perspective, we can simply observe what they're doing and see what the likely consequences are. And so, as a simple example on the upper left, for all the talk of the great Chinese rebound and I think beautiful deleveraging of 2024, it clearly got a lot of demand going from foreign investors investing in foreign Chinese stocks, listed here by the Hong Kong market. But that has faded in recent weeks. And the amount of the rebound that we've seen in the Shanghai market, it's basically faded, all the hope in the Shanghai market. And instead, the Chinese economic conditions in the lower panel basically haven't changed if you read a timely basis based on the PMIs. And if anything, the pressure on the Chinese currency has continued to be relatively substantive, with timely measures of Chinese intervention in the upper right, showing some of the most significant intervention needing to be taken since the currency missteps taken in the mid 2010s, with the currency trading up at against the band, and significant intervention occurring. For most, in most cases, for most investors, this doesn't really have too much of an impact, in part because while the Chinese are intervening, or there's indications that there's direct and indirect, primarily indirect intervention through the state-owned banks, most of that's done on the short end. And so it's not really having an impact on global asset prices the way the significant sales that happened during the mid 2010s currency problems. So it's not really having much of an impact on Western investment and economies. But where it is having an impact is on the gold market, where the continued pressure on the Chinese exchange rate continues to put sort of a bid under gold. Even with higher U.S. interest rates, that bid on gold continues to exist. I think some of the interesting market action that we're seeing, today, I think is an interesting example where you're seeing, bond yields rally and gold sell off. That's a sort of dynamic that would be unusual, since typically gold rallies when bond yields are falling. And the reason why that is because, gold is non-interest bearing money. And so lower fiat bond yields should lead to higher gold prices. But what it highlights is maybe the transmission mechanism is not through the US bond yield, but through the pressure on the Chinese currency. With US bond yields falling, pressure on the Chinese currency moderates to some extent, which then creates less pressure for domestic residents to be buying gold and therefore causes gold to fall. That's a flippant correlation that's pretty unusual relative to history, but I think aligns with the fundamental pressures that we're seeing. And the reason why that I connect to the fundamental pressures is to highlight just how important Chinese gold demand has been in terms, or how much gold has benefited from the Chinese stress, whether it's sales of U.S. financial assets shifting into gold by the central bank, or whether it's private purchases of gold in China, given that there aren't a lot of other investment options. Stocks are weak and falling. House prices are falling rapidly. Very challenging for Chinese residents to move money abroad. And so really there's just not a lot of options left. Wealth management products, have largely been undermined in terms of their credit risk and long-term expected return. There just is not that much of an option if you're a Chinese or a Chinese onshore saver. And so gold is one of the few options that's available. And so we're seeing that occur, whether it's the bid in gold as a function of the Chinese demand. Gold in yuan has continued to rally, or whether it's the literal non-monetary imports of gold that we're seeing in the trade balance. So gold being the primary beneficiary of the Chinese stress. All right, we'll go to questions. We'll go to audience questions here. Give me a second. If you have other questions, feel free to enter them. I'm just going to take a sip here and we'll get into these questions. I think I'll hit the first question here, which is with inflation data surprising to the downside and the Fed surprising to the hawkish side. Does more Fed hawkishness need to be priced in? And I think the short answer of that is that the current story in terms of the Fed hawkishness, let's say trading on the short rate side, a lot of, as I said, sort of a lot of the easy money there has been made. Given the confluence of conditions, particularly seeing a bit of weakening growth or rise in unemployment, all that kind of suggests that, or I should say, reaffirms that, more likely than not, much more likely than not, the Fed is either going to be on pause or it's going to be cutting rates from here. And so the real question is, how fast do they transition to that point? And one of the ways in which they can basically maintain or create tight monetary policy is just by continuously pushing out expectations of easing. And I think this story, the presser and the dots that we saw yesterday, I think was a good indication of how they intend to signal that, which is sort of constantly say, we're going to cut, but that cut's going to come into the future until they get the macroeconomic data that aligns with it. So, could we see 2 years bump back up to 5? Sure, it's possible. It's not really the difference between 4.75 and 5 on 2s. It's just not that big a deal. Odds are they'll keep pushing this out, and we'll start to see maybe later in the year unwinding some of those expectations of cuts that exist in 2025. If we go up here, some question about basically what's going on with some of the wage data. I think it's pretty well triangulated that wage growth data across a lot of different measures continues to be a point or two above where we were pre-COVID. The ECI being an indication, but you can look at Atlanta Fed, you can look at average hourly earnings, you can look at, as an example, the compensation of employees, which is referenced here, uh, is still above where we were on average on a pre-COVID basis. And so that's really the sticking point is we have inflation, we have wage inflation that is above where we were pre-COVID. And at the same time, we have productivity growth that's looking a bit weaker than where we were pre-COVID. And you add those two things together, and that's the combination of dynamics that would create more structural inflation in the economy. What are the market-based measures that are signaling higher prices and growth other than analyst estimates or economist forecasts? Well, stocks are at all-time highs. And so, there's probably no better indication of strong growth expectations than stocks continuing to push to new highs. And so I think in a lot of ways, the analyst estimates, they're a reflection of the fact that the overall sentiment towards U.S. equities is very strong in the market on a sort of strategic basis. And so, the fact that stocks are pushing new highs is a reflection of the fact that stocks are pushing new highs in an environment of elevated interest rates, over the course of the last couple of years. All of that aligns with the fact that the market participants' expectations of future growth are very strong. And then, you can look at things like economists and analysts' expectations, and they, of course, are also aligning with that. And that's really kind of gives you a full triangulation. If stock prices weren't nearly as elevated as they were, or if you didn't see such a squeeze in equity risk premium, then you could sort of question whether the analyst expectations and the economists are really getting it right in terms of what the market's pricing in. But all of these things triangulate and combine and show the same picture, which is very elevated growth expectations in the US. And then sort of a last question here, and then we'll have to wrap up. Thank you all for sticking around past the top of the hour. But one last question here, and we'll wrap up, which is a question of basically, can the AI boom create, a strong economic set of conditions, akin to what we saw in the late 1990s? And what I'd emphasize there, it really comes down to productivity. And in order to get a low inflation or falling inflation, strong growth environment, we have to have a significant increase in productivity. And the truth is, predicting productivity is a challenging task for any macroeconomic investor, certainly any macroeconomic investor looking at it over, say, a 5 or 10-year period. What I'd emphasize is or to give some perspective, essentially the biggest productivity boom that we've seen from technological innovation in the post-war period was the introduction of the personal computer, and that added something like 1 to 1.5% real GDP growth on an annualized basis, say starting in the late 80s and moving up into the late 90s. That kind of gives you a sense. It was paired with huge amounts of business investment that was necessary to get the original tech boom to occur. If we look at what's going on today, the orders of magnitude are quite a bit smaller. The amount of investment that's being discussed, on a global basis related to AI is in the tens or low $100 billion, which is de minimis on a global basis. And the main question is, what is the productivity enhancement? So, so the second order effects of supporting GDP growth are relatively modest, certainly compared to the magnitudes that we saw during the let's call it the tech boom number one. And then the second question is, what are the productivity enhancements? And that is a much more ambiguous question, where I think we've got to look at the story and be, you could be a techno-optimist, you could be a techno-pessimist, but I think what you have to be is a realist in terms of looking at the data, understanding the data, and seeing what it's telling you. So far, there is no indication that there is a significant support to U.S. worker productivity coming from AI-related technologies. Now, that may change in the future, and you should be open-minded to that possibly changing in the future. But as an investor, you also have to be open-minded to the fact that it may not be nearly as significant as what a techno optimist might say. And so, that's the nubby question. I think, it's very hard to understand, very hard to know whether it's likely to move in one direction or another. And so that's why it's so important to be grounded in the data when you're looking at what's happening. With that, thank you so much, everyone, for joining us this month. Really appreciate you spending a little bit of your week with us and asking all these questions. And look forward to speaking with you all next month in our July macro webinar. Have a great June.